Welcome back to Wealthy Business, the channel where we break down the biggest global stories in finance, investing, and personal growth, helping you make smarter decisions with your money. Today, we're talking about a warning coming straight from the top of Wall Street. Both Goldman Sachs and Morgan Stanley, two of the world's most powerful investment banks, are sounding the alarm. After months of relentless gains and record-breaking stock prices across the globe, they're telling investors, get ready for a correction. Let's unpack what they said, why it matters, and how it could affect your portfolio over the next 24 months. The global rally that defied expectations. This year has been one of the strongest in recent memory for global equities. The S&P 500 and Nasdaq in the US hit record highs, powered by tech giants and the ongoing AI revolution. Japan's Nikkei 225 and South Korea's Kospi also surged to new peaks. Even China's Shanghai Composite, after years of underperformance, climbed to its strongest level in a decade, helped by a softening US dollar and easing geopolitical tensions. Investors around the world have been celebrating. But as always, when markets rise too fast, too far, the smartest people in finance start asking, how long can it last? Suit Goldman Sachs, a healthy reality check. Ahead. Speaking at the Global Financial Leaders Investment Summit in Hong Kong, David Solomon, the CEO of Goldman Sachs, delivered a clear message. He said, "It's likely there'll be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. Things run, and then they pull back so people can reassess." In other words, Solomon believes that even though the rally has been strong, it's natural for markets to correct. He emphasized that pullbacks of this size are not crashes, they're part of the long-term growth cycle. He added, "A 10 to 15% drawdown happens often, even through positive market cycles. It doesn't change your fundamental belief in how to allocate capital." So, Goldman's message is clear. Don't panic, but prepare. If you're investing for the long run, volatility is simply the price you pay for growth. 3. Morgan Stanley. Pullbacks are a sign of market health. Sharing the stage with Solomon was Ted Pick, the CEO of Morgan Stanley. His message was similar but carried a slightly different tone. Pick believes that periodic drawdowns are not only inevitable, but healthy. They help markets rebalance after speculative surges. He said, "We should welcome the possibility of 10 to 15% drawdowns that are not driven by some sort of macro cliff effect." In simpler terms, he's saying that markets need to breathe. Without corrections, valuations can become disconnected from reality, leading to bubbles. Pick, like Solomon, doesn't expect a crisis. Instead, he sees a necessary cooling-off period that will set the stage for more sustainable long-term growth. The warning signs are already flashing. This isn't the first warning we've heard recently. The International Monetary Fund, IMF, has also cautioned that global asset prices may be stretched. Meanwhile, Federal Reserve Chair Jerome Powell and Bank of England Governor Andrew Bailey have both raised concerns about inflated stock valuations. Add in the uncertain global outlook, from slowing growth in Europe to trade tensions between the US and China, and it's easy to see why major institutions are starting to sound cautious. But there's another layer to the story, one that could define the next major investment trend. The bright spots, Asia's rising momentum. Despite the warnings, both Goldman Sachs and Morgan Stanley remain bullish on Asia. Goldman noted that recent trade agreements between the US and China are easing tensions and creating opportunities for investors. They believe global capital allocators will continue to see China as one of the largest and most important economies in the world. Morgan Stanley's Ted Pick also highlighted several markets he's particularly excited about: Hong Kong, China, Japan, and India. Here's why. Japan is undergoing a wave of corporate governance reforms, making it more attractive for global investors. India continues to grow thanks to massive infrastructure projects and a booming tech sector. China is still home to major innovation stories, especially in AI, electric vehicles, and biotech. As Pick put it, It's hard not to be excited about Hong Kong, China, Japan, and India. Three vastly different narratives, but all part of a global Asia story. For investors, this means one thing. Even if global markets correct, Asia may still be the growth engine of the next decade. 6. What should investors do now? So, how do you navigate this environment? Here's what Goldman and Morgan Stanley recommend, and what it means for you. 1. Stay invested. Don't try to time the market. Corrections are normal, and missing just a few strong recovery days can destroy long-term returns. 2. Review your portfolio. Make sure your exposure aligns with your risk tolerance. Diversify across sectors and regions, including emerging markets in Asia. 3. Focus on fundamentals. Companies with strong balance sheets, positive cash flow, and real earnings power tend to survive downturns and thrive afterward. 4. Think long-term. The best investors, from Warren Buffett to institutional funds, know that volatility is temporary, but value creation is permanent. Wealthy business takeaway. This isn't a time for fear, it's a time for discipline. Markets move in cycles. After a year of euphoria, a 10-20% correction isn't a disaster. It's an opportunity to buy great assets at better prices. As David Solomon and Ted Pick reminded us, the real winners aren't those who avoid drawdowns. They're the ones who prepare for them. So keep your eyes on the long game, stay diversified, and remember, corrections don't destroy wealth. They transfer it from the impatient to the prepared. 25 hashtags. Wealthy business, stock market, global markets, investing, finance news, Goldman Sachs, Morgan Stanley, market correction, economy, AI stocks, Wall Street, market trends, portfolio strategy, investors, trading, stock market news, global economy, investment strategy, financial markets, China, India, Japan, market insights, business news, long-term investing.